Hello there, Prof. Aram here, and in this video we're going to evaluate and look at the history of returns in financial markets and see what can we learn just by looking at the returns, the progression of the returns over the recent history of the financial markets. So let's get to this. First of all, let's talk about the importance of financial markets. The main function of the financial markets is that they connect the savers of the economy to the borrowers of the economy. Savers choose to defer their consumption for a return in their investments, and then borrowers have better access to capital that's available for them, and they can invest it in projects that can generate value for their owners. This is the main function, but a very important function is that these financial markets provide information regarding the returns, regarding the assets in the market, regarding the performance of the assets in the market and their level of risk. So what kind of returns you can expect and what kind of risk you should see in these type of assets. Here is a graph of performance of different asset classes over a 95-year period, starting from 1925 till 2020. This graph shows how much $1 invested in 1925 has grown over time. So here we have large company stocks. Say these are the S&P 500 firms, which are basically the 500 most valuable firms in the market. And then we have a small company stocks. These are smaller firms. And then we have long-term government bonds. Say these are government bonds with maturities between 10 to 20 to 30 years. And then we have short-term government bonds. These are 3-month treasury bills. The first look of the graph tells you that the best performance over this 95-year period was for the small company stocks. The $1 invested in 1925 has grown to almost $42,000. So that's the best performance overall. And the worst performance is for the short-term government securities, 3-month treasury bills. Dollar invested in 1925 has grown to only $20 in 2020. But a closer look at the graph tells you another aspect of these returns. The one with the lowest return is the most stable, is the least volatile of all. And the one with the highest return, a small company stocks, is the most volatile of all, especially like here during the Great Depression, you see how volatile the small company stocks were. So this is the lesson that we talked about before. There is a reward for bearing risk, and the higher the risk, the higher the return. We're going to talk about how to measure risk in a couple of videos, but just so you know, the higher the risk, the higher the return. It's one of the lessons that we learn by looking at the history of financial markets. Let's look at some of these asset classes in more detail. So this graph shows the year-to-year return for large company stocks. And for these graphs, I want you to pay attention to the scale of the graph. In some of the best years, the large company stocks have returns of close to 50%. And some of the worst years, they have losses of more than 40%. But this is for large company stocks. In a small company stocks, you see that some years, very good years, you have close to 150% return in your portfolio of small cap stocks. But also in some years, you'll have a loss of more than 50%. You lose more than 50% of your value of your portfolio. And then here are the long-term government bonds. As we talked about before, long-term government bonds, they don't have the probability of default, but they still have interest rate risk. So that's why you see these losses in a few years over this 95-year period. But For short-term securities, the 3-month treasury bills, they don't have any losses. That's why usually we consider short-term treasury bills as risk-free assets, because usually you don't lose money on these short-term securities issued by the government. And finally, let's look at the inflation over this 95-year period. Before 1950s, there were a few years then you had deflation. Basically, the prices dropped. But overall, the US has experienced a steady rate of inflation between 2 to 3% in the recent history. And you need to calculate your inflation adjusted rate of return, because it is your purchasing power that is important, not the nominal rate of return. So let's say if the inflation rate is close to 10% and in this particular year your total return is 20%, your actual rate of return is going to be 20% rate of return minus the 10% inflation. So you end up with actual 10% rate of return instead of 20%, because inflation erodes your total rate of return, erodes your purchasing power. I hope you find this video useful, and thanks for watching.